All right, in this segment, we're going to do section 6 and 7, talking about transaction costs and financing, which I think kind of go hand in hand. Now, transaction costs, as an overview, is anything that's associated with the transaction itself. Closing costs are underneath that umbrella, but they're a lot more specific to actually things that it costs to close the loan. So the reason they call it transaction costs, so we can use the money for more things. As you will see, it includes all costs and closing costs resulting from selected financing. So if it's a VA loan, it covers all that stuff too. Prepaid recurring items, any kinds of insurance, if it's mortgage, title, stuff like that. Discount points. So sometimes people want to buy down their rate. It's not really that apparent in this market or that sought after in this market, but when interest rates go higher, people want to buy down that rate because that's tens of thousands of dollars. And all costs to obtain information or pertaining to the owners association, if you have to get any kind of certificate of assessments, or it also covers interest, non-recurring closing costs, title exams, allowable costs that are associated with certain types of loans like VA and FHA, any fees and expenses of the buyer's attorneys, contractually required real estate compensation, and the cost of any inspector, appraiser, or surveyor. So let's break this down real quick. Prepaid items. So this is where it kind of goes on a tangent, but prepaid items are just what they sound. They're items you prepay. So when you go to close on the house, let's call it June 30th, because it's the middle part of the year, you have to pay your insurance bill for the entire next 12 months. Insurance is paid going forward, so you're protected. Your mortgage and your taxes are paid in arrears, meaning you pay this month for last month. Well, what happens is you have to start an escrow account with your lender, most likely. Very few people don't have to do that. And so what you have to do is you have to pay for your insurance for the first 12 months. You'll see that on the HUD, the buyer will. And then the escrow company will also want to put a buffer in there in case things go sideways or if insurance goes up. So they'll take an additional 3 months of that. And that's called the prepaid, as well as the insurance. Now, taxes, since we're closing on June 30th, that will actually be paid the first of the year. It's a set date. It's June 15th. They come out in October. They're paid. Well, your escrow company is going to pay that for you. So you're going to get a credit. The buyer's going to get a credit for half the years of taxes because the seller lived there and they got to pay for when they lived there. And then the buyer will get a credit on closing, and then the buyer's got to pay the entire thing. Well, what's going to happen is the escrow company is going to take that money from the seller, put it in your escrow account, and then put another 3 months buffer in there. And then every month when the buyer makes a payment, part of their payment is going towards their insurance and taxes. So when those bills come due, the escrow company pays it for them, and they'll never know the difference, instead of paying one big lump sum in January, which sucks. So that's the prepaid. The recurring items, prepaid recurring items is one thing. Any kind of insurance. So if buyers don't put down at least 20%, they might have mortgage insurance. It's a fee that you have to pay on behalf. You're betting against yourself, saying, hey, as long as I don't default here, or if I do default, this mortgage insurance will pay my mortgage company back for taking a risk on me. Title insurance is protecting the title, so that way that makes sure if somebody sold it 3 times ago that they actually recorded their satisfaction of mortgage and everything else, and they don't come knocking on your door saying, hey, I actually still own this house, and you're like, well, I didn't buy it from you, I bought it from somebody else. So title insurance is required by the lender if you get a loan, and you have to pay for that on the lender's behalf. And then you can get a secondary policy, which is a lot cheaper, that covers you. So if that guy did knock on your door and it went to court and he actually does own your house from 3 times ago, the insurance company will pay the lender off saying, hey, sorry about that. That's our bad. Here's your money for the house, your investment. But they could just kick you out on the street unless you had owner's insurance, owner's title insurance. And there they go, well, we are selling it. We do have to give it back to this guy, but we're going to pay you out for your pain and suffering. And they'll also pay for attorneys to fight for you. So it doesn't happen often, but it is something that I highly recommend. Most attorneys require that buyers get owner's title insurance because it's something you need to have. Flood insurance, we get that. Hazard insurance is just your regular homeowner's insurance. We talked about discount points, homeowner association stuff. Title exam, what the attorney does for you, they send an abstract to the courthouse for the buyer to make sure that all the boxes are checked and that the house has changed title correctly so they don't have to use their title insurance. And of course, any fees with the buyer's attorneys and anything else. But it then goes on to say, well, what does the seller have to pay for? Well, the seller is going to be responsible for their transaction costs, which include the deed preparation, the deed recording cost, and the deed stamps, which is really a tax. And a lot of people are going to ask you that because it's not law that the seller pays for. It's just what the contract says. So people will come from other markets and be like, who pays the closing costs or who pays the deed costs, deed stamps? Well, it's in here. The seller pays the deed stamps. And they have to pay for all costs necessary to deliver a marketable title. So if you got a survey done and you go, hey, that brick fence is on our property, we want that off our property. Well, the seller is responsible if there's any fees to make sure that it is done that way. And they're for any property taxes, which will be prorated at closing, which I talked about earlier, and they're required to pay the real estate broker compensation, which we've already done a buyer agency at this point, but then it further on says that they are paying our compensation and any fees or expenses of their attorney. At closing, the seller will pay the buyer's transaction cost not to exceed a dollar amount or a percentage. Well, how much do they ask for? Well, guess what? I don't know. Because it depends on them. So that's why you have to talk with an attorney. Because if you don't, and you just came in here and said 3%, well, 3% on a $300,000 house is $9,000. That's a hell of a lot of money. And any excess funds will revert to the seller. So say you only use 6. Well, 3,000 is going to go back to the seller. Well, that doesn't make sense. You should just offer $3,000 less. So you've got to talk with the lender at this point to make sure that is right. If not, you're just guessing. And anything if you need more closing costs than what you asked for, that'll come out of your buyer's pocket. And if your buyer doesn't have that money, how are they going to buy a house? If no closing, the buyer is responsible for the buyer's transaction costs and seller is responsible for theirs. That's a big part here. So if this deal falls apart, at any point you need to let the client know that the attorney's already doing title work and the lender's already doing an appraisal and so on and so forth. So if this deal shuts down, your buyer's going to be responsible for having to pay that stuff back out of pocket, and they still won't have a house. So it's very, very important that the buyer understands that if they're going to get butthurt over $500 because for a repair, it could cost them a couple thousand because they're going to have to pay for inspections on the next house again. They lost all the money for the inspections on this house, so it's just really important to kind of use that. So let me know if you have any questions about a buyer backing out of a deal, because oftentimes when you lay the cards on the table and show them the actual cost, they'll be like, fine, I'll just pay the $500 for the repair instead of losing $3,000. The private, also, if you don't have any closing costs, you just put 0, NA, no closing costs, which also happens very often, but you just got to know if they're going to be paying it or not. The private public transfer fees or any costs similar to that, like capital gains or estoppel fees or anything like that, to the homeowner association, are the seller or the buyer's transaction costs. So I apologize, not capital gains, capital contributions. So it's like, hey, you gotta start your homeowner's account with the homeowner association, and you gotta put in $300. And there's like $300 in estoppel fees or anything else. Who's gonna pay that? The seller or the buyer? It's all negotiable, but hell, I'd put the seller on it, right? And otherwise agreed to in writing, the buyer will pay for the buyer's transaction cost and seller will pay for the seller's transaction cost, which agreeing in writing will be right here. So about financing. So that's how we're gonna get money to buy this thing. So you gotta imagine it's got some loopholes to it. Not loopholes, but it's got some hoops to jump through. So, and also has some loopholes, to be honest with you. But the buyer's obligation under this contract is or is not contingent on the buyer getting financing. If they're getting a loan, it's going to be contingent on financing. It needs to be contingent on financing. Because if financing falls apart, they can possibly get out of this deal. So you would be doing a disservice to your buyer if it's not. Now, some people will say, don't make it contingent on financing so my offer looks stronger, but they need to have a backup of being able to pay cash in case financing falls apart. So again, how do buyers want to know how they can get out of contracts? Here's one of them. You also need to say what kind of loan they're getting. I don't know why. I don't know why they asked this, but they do. So they're going to get a 30-year or a 15-year, or is there something else that they're doing? And it just goes on to talk about how much they're going to put down or how much the minimum loan amount is. So it's the back math. If they're putting 20%, so they're going to get a minimum of an 80% loan and a maximum of a 100% loan. And it then goes on to the financing contingency. So it's contingent on financing. If we check the box above, it expires at closing, which is crazy. So if their financing falls apart at closing, they don't have to buy the house. So think about it this way. The buyer is buying a house, and what happens though, you get a pre-qualification letter from the lender saying, hey, your buyer, when they first talk to me, can buy a house based on these terms. Well, once they go into contract, then that's when the lender starts um, kind of pre-qualifying the house too, because if they're getting rural housing, the house has to be in rural housing. If they're getting a VA house, the house has to pass certain specs, so that they won't know all of that. They don't pull their tax information, they don't pull their pay stubs until they go actually under contract. So it takes a little bit of time for the lender to get through all this stuff. So that's why they give them so much time for this financing contingency. But what it goes on to say is the buyer must make timely good faith efforts to apply for and obtain financing while refraining from contrary actions. So they can't go buy another house. They can't go buy a car that would affect their ability to buy a house. Now, if it's not through any fault of their own, so be it. But if they do a contrary action, they could be put in default. In a timely manner, the buyer shall inform the seller and the brokers of pertinent financing issues and authorize the buyer's lender to disclose the pertinent loan information to the seller and brokers. Now, they can't tell them like their credit score is. They can't tell them like how much their debt to income is. But they can say, yeah, we're having a stumbling block with the VA, or we're finding we need to find some more down payment money, or whatever it might be. The buyer shall apply for financing with blank amount of business days. I think 5 business days is good to apply for financing from the effective date, which is the date the contract is signed. I will tell you, a pre-qualification is not applying. There's actually application and another step that needs to be done, and that needs to be done within that timeline. Because if you're doing a 30-day closing, you've got to apply for financing, you've got to do inspections, and all this other stuff that really adds up. So 30 days goes pretty quick. What it also says is that we shall deliver notice to the seller of a reasonable pre-final loan approval that contains no unreasonable credit, income, or asset conditions within. It's really kind of open here. You need to talk to the lender and see what's doable for them, because we're putting it on paper. But I would think something like 20 business days or something along those lines would do that. But always ask the lender to make sure we're doing it right, and that's from the effective date. Final loan approval occurs when the lender funds loans. When they hit the button at the bank and the money shows up at the attorney's office, that's when final loan approval happens. If a lender subsequently declines or fails to approve financing, the buyer shall notify the seller and brokers as soon as possible. If the sellers and brokers are notified of an inability to obtain financing during the financing period, which is up here, either party may terminate this contract by notice, and earnest money shall be returned to buyer. But it says may terminate. So if a buyer goes, hey, I want to buy this house under rural housing, and the seller's like, sure, I don't care, and they get denied because the house isn't actually eligible for USDA housing, rural housing. Well, what they can do is go, hey, I understand that. So the buyer goes, I'm going to flip over to FHA. The seller's like, cool. So that's why it's not automatically terminated, but it may be terminated. The lender, you put their name here, and it says they may change. And then it talks about the lending types, right? If it is an FHA or VA, there's a special addendum. It's called a VA FHA escape clause. So either it is attached or is not. I would say is not attached, because they're going to have to sign one for the lender by closing. And the one that we usually send them to sign is not the one they want. So it's just a cluster. Just wait for them to do that. And then if there's additional financing terms, they are or not attached. So if they want to do seller financing or anything of the sort, they can write that stuff out. If they want to do seller financing, by the way, let me know. That's the check here where it says seller. It gets really kind of messy, and it's beyond the scope of our license. So we need to get them with an attorney because he has to make a mortgage for them and all these other things that need to go on. So that rounds us out for financing. And that rounds us out also for the transaction costs. So stay tuned for the next section. And if you have any questions, always reach out.